Hello everyone and welcome into the channel. My name is Brent and in today's video we are going to be covering the M1 Finance dividend portfolio update. February is over and dividends are in. I was paid over 10 times in February. So we're going to go ahead and cover which companies paid out this month, so definitely stay tuned. And of course, in case you are looking for companies that are paying out in February, this is probably going to be like a good little hint towards, hey, here's some potential companies you should you can check out. So also question of the video here, question of the week or so, how much are you getting in dividends on a monthly basis and on a yearly basis? I think that's kind of a nice little question to ask. How are you doing on a month to month, year to year updates? If you guys are just getting started, let me know. But if you guys are long-term dividend investors, that'd be something interesting to kind of share. So really quickly, we're going to go over 5 things today. Number one, we're going to go ahead and cover the overall performance of the portfolio. Where are we at? A lot of portfolios out there between 2020 2023 actually went into the negative and have kind of potentially they're in that sweet spot right now where they're not really positive, they're not really negative, they're just kind of balancing themselves out if they started around 2020 and from there, right? Number two, we're going to go over into the weekly performance in our portfolio, take a look at which positions were up, which positions were negative for the week. Number three, the dividend update. So we did get paid out over 10 times in February. So we made over $100. So we're going to go ahead and cover which companies paid out the dividends. And I did actually sell out of a company completely. I have completely removed it. As far as equity, I'm going to go ahead and remove it from my portfolio in this video. And then number four, we're going to update our dividend tracker with our current equity and our positions. And then number five, we're going to talk about some current news. There's some stuff out there that I've seen a lot of investors either discussing here on YouTube or on Facebook, but there might be other stuff that I'm not, seeing. So if you guys have, we'll check out what I am going to share. And if you guys have anything on top of that, you guys can drop it in the comment section below. Okay. With that said, let's go ahead and get into the video. So starting off over on M1 Finance, we're going to go ahead and hit up the overall update of the portfolio. So for here, we go over to our invest tab. And of course, if you guys are interested in starting on M1 Finance, have not yet started investing, I know that there are so many more investors today than there were 5 years ago when, everybody was jumping on the Robinhood train, the M1 Finance train. There's Webull out there. There's so many platforms. Here on YouTube, everybody is promoting and pushing out, content and brokers. So if you are not yet started, then definitely check out M1 Finance. I do have a link down in the description below and also in the comment section. But M1 Finance is one of the preferred platforms that I use. And overall, we can see here, we're up 53.28%. We did move up slightly over last week. We're up a little over $6,000 in market gains. So overall, since we started this portfolio back on January 7th of 2018, yes, that's right, it's over 5 years old, the portfolio has remained net positive, but it did get really, really, really close to being negative here throughout 2020 to 2023. There were some blips there where, man, it got hit pretty hard here. You can see in 2020, we started that event around 22,000, dipped all the way down to about 14,000 at a low, came back up, and we have just been chugging along since 2020. You can see the performance there over that long term. So the main thing is, hey, continue to be stay invested, continue to add equity, and your portfolio will grow so long as you're invested in solid companies, right? That's the overall gist of investing. So we're doing really positive. We can see here our best performers: Apple, AbbVie, and ABM Industries. All letter A's. That's the key thing there. Invest in companies that start with A. No, I'm kidding. Don't do that. Our worst performers down here. So Stanley Black & Decker is the position that I've completely removed out of my portfolio. You can see that it now stands at 0 equity in there. IIPR is down 49%. This thing is bleeding out money, but it is actually positive from where it was not too long ago. At one point, it was down 60%. So, hey, I'm patting it virtually on the back, saying, hey, you can do a little bit better for me. Come on. DLR is right behind it. Digital Realty Trust. Clorox, this one, I'll give it a solid handshake. it was down about $1,500 in equity, total equity invested or that it was worth. So it has popped up a bit from its lows, and it's on the up and up. Hormel Food, Waste Management, and Colgate. Essex Property Trust is another one that just kind of went negative in the portfolio, but overall, outside of Stanley Black and Decker and potentially IIPR, I don't worry about any other companies. This one right here, it's in the MJ industry. So with legalization, federally, state, and it's getting cheaper to produce for everyone and just getting easier to get your hands on it. So it's not as effective as a business model as it had been way back when states weren't completely legalizing it and it was kind of here and there. So IIPR might get beat around the bush or just kind of beat around. So we'll see how that sits. Honestly, I would love to take the equity and move it elsewhere, but just kind of not, locking that loss of 939%, $394, $39. Geez, I can't talk. That just kind of hurts. So I'm just gonna let it sit there. Hey, it's already down 50%. How much more can it go down? It's the next tattooed chef, right? Tattooed chef's like down 90%. They could do that, but we'll see how it goes. It's not going to hurt any more than it already hurts. Just leave it sit, and I own those shares already, so I will let that be. So up top, let's go to our weekly now. Number 2, our weekly performance here. We can see for the week, we are net positive in market gain, and we earned some dividends along the way. We can see that our best performers this week, holy cow, check that out. IIPR up 6.33% on the week. Main Street Capital up 3.12. Apple, oh, it's getting some life onto it. That's a big jump for a FANG company. So nearly up 3% on the week is huge. That's actually really, I didn't know that. That's actually a surprise to me. Starbucks up 2.9. AbbVie, our worst performers this week, Hormel Foods, down nearly 10%. Holy cow, that's a good hit right there. Merck, Pfizer, Johnson & Johnson. Hey, these are 3 healthcare companies. Healthcare had actually been doing really, really well. So to see these companies here take a little bit of a time off to themselves is actually not bad. They're only down 1 to 3%, so really nothing to kind of like, oh my goodness, none of that. Lowe's, Waste Management, Realty Income, nothing to see there. Nothing surprising. So overall for the week, net positive. Not by much though. It's actually interesting how it didn't, it wouldn't seem like these little pieces here would have such a negative impact on all of the green up here for the week. But look at that. I'm only up 133 on the week, despite, these positions being up 57, 50, 73, 85, 24. It's basically ABM, right? Yeah, Hormel Food took it. Okay, $200 loss right there. That definitely hurts against those gains. So that is number 2. Jumping into the number 3, the all dividend activity, the activity overall for the portfolio. So again, February just finished last week, and all the dividends are in for the month. So we did get paid out over 10 times. So it's nice to see, hey, you get at least 2 dividends paid out per week, and it adds up. It does add up. So our companies here were ABM Industries, paid out $5.53. We had Lowe's. Lowe's is just a great company long term. Lowe's and Home Depot, those are kind of, people have their selection of which home improvement store they go to. But for a choice of mine, I generally go to Lowe's out of the 2, Home Depot and Lowe's. So they paid out $12.64. Clorox here, $13.38. Colgate, $11.38. AbbVie, $12.12. Hormel Foods, $12.84. Main Street Capital, $8.94. Realty Income, $6.82. And, we got 2 more. Apple, $3.90. Apple is not a company that you invest for that dividend because they have a super low yield, less than 1%, I believe, right now. You don't really buy them for the dividend itself to be reinvested. You generally buy Apple for the growth. Apple is one of those dividend growth stocks companies where they don't really focus on their dividend payout, they focus on that growth. And Starbucks, a whopping $15.43. So that is a huge payout there from Starbucks. And we decided Starbucks not too long ago. I don't count Siggy Selective because that is here in March. That is, already starting off March strong with Siggy and Pfizer, but we're not going to include that. So just in February, we were paid out $102.88. So that kind of goes on to our average. So as far as our dividend tracker goes, on average, we make about 120, a little over $120 on average per month. A little, actually more. If I do the calculator here, 1387 divided by 12 is actually $115. Okay, so $115 is our average monthly dividend. So, getting $100 here in February, that was invested, and that, I invested that at the very end of February. So we have $22.63 to begin investing again for March, and that is Siggy and Pfizer that have paid those out. Again, we did take Stanley Black & Decker, some quick activity here. Stanley Black & Decker, we removed $486.32 from that position, and we moved it into Waste Management. I feel like Waste Management is on a downhill trend right now. It's not, these are actually a reverse of how you should invest. I'll show you guys really quickly. Honestly, as a long-term investor, if you were willing to accept that Stanley Black & Decker will bounce back, it's actually showing signs that it is on an up recovery. On the other hand, Waste Management is showing signs of on the downhill, right? We'll show that right now, actually, because then I can show you why, you'd pick one over another. So here's Stanley Black & Decker 6-month performance. Let's look at the 3 years, and you can see that this one got beat the heck up over the past 3 years. It had a high back in 2021. I've had this position for a few years, so I never bought it at this $200 price point, but hey, I never sold it either. So I don't know whether to be happy or not happy. It doesn't really matter. But here we had that death crossover 50-day under the 200-day. That would have been a good sign. Hey, this company is about to go on a huge downhill. And guess what happened? Boom, slid off a cliff right here, but it is on the uphill. So as of just a few months ago, it has been on its uphill recovery. You can see it bottomed out. Looks like maybe October-ish period, and has been on a slow incline. But when I posted in the revenue, the net income on this company over like a 5-year period, I think, let's see here, revenue is moving positive. So, it did lose, we saw in 2020, you saw that revenue drop sharply, and that didn't really affect anything. Oh yeah, it did affect it here. You see that huge drop in price, and that's that drop in revenue, drop in earnings, not as much, not as noticeable here. But net income is actually still on the downtrend. So even though the company itself is recovering slightly, their net income is still on the decline, whereas the revenue is actually moving slightly positive. So they're actually on a bit of a recovery. Waste Management, on the other hand, if we take a look at this one, has done really well over the past, if we look at 3 years, I think we bought this one. This one's still positive. We may have bought it on a dip way back when. Let's go back to here and let's go look at Waste Management. What's our average price on Waste Management? So wait, right there. Oh wait, no, it's negative a bit. Our cost basis is 155.62. So we bought it around in this time frame. We might have bought it here in this dip. We may have bought it back here in this dip. But either way, our average price is 155. It's trading at 150.08 right now. And you can see that if you were to pick up this one, it may actually fall to, in the 140s. Right now, it's broke through every potential support. It's recent support. It's even broke, or actually it may not have broke at that point here, but still, it could still continue to fall to 140 or even below. There's no support right now. So whereas Stanley Black & Decker has some support and showing signs of recovery, Waste Management, on the other hand, the price for the company is actually on the downhill trend. So I'm throwing I'm throwing one knife and catching a falling knife right now. So I'm just kind of, will it bounce? Will it recover? I don't know. But long term, I feel like Waste Management is just a better off than Stanley Black & Decker. So that is the activity update. I don't want to drag it too long right there. So number 4 is updating our activity tracker, our dividend tracker here. And that would be with the removal of Waste Management. So if we head down to, no, we got rid of Stanley Black & Decker. So Stanley Black & Decker right here, it used to pay out $18.32 to us. That's a good chunk per year. Annual income, $18.32. That we're not going to get anymore. Let me go ahead and just copy this line real quick. So what we're going to be doing is moving that equity, right? We move that equity into Waste Management, which currently pays out $38.26. That's actually a really nice chunk. So let's go ahead and delete Stanley Black & Decker from this portfolio, and we'll go back to, we'll edit Waste Management, go to M1 Finance. We can see here at Waste Management, we own 17.61365 shares at a cost basis of $155.62. Okay, so we jump back over to track your dividends, and we can update our tracker. So we went from 13 shares in 66, 13.66 to 17.61365. Our cost per share went from 157 to 155.62. And again, we were receiving $38.26. Now we're receiving $29.32. So we're not quite making that $18, that we, 49.32 minus 38.26. We removed $18.32 from our income, our dividend income, and we added $11.06 to Waste Management. That's because of that yield. We lost the 3.67 yield that Stanley Black & Decker had, and we transitioned to Waste Management, which only has a 1.87% yield. So that is going to affect our overall income, which dropped there. We can see it dropped about, what, $7 or so? But overall, I feel like the portfolio is a little bit healthier. So this should now match up 46,639. 46,639. Yep, that matches up exactly as it should. So now we have done our overall performance. We cover the weekly performance, the dividend activity, showing that we got paid out from 10 different companies over $100. We updated our dividend tracker. So let's talk about some news here in February, March timeframe. The main thing that I have seen everybody talking about is the inverted yield curve. And while this is a big thing to kind of see, in 2020, we did have an inverted yield curve, and then we had that flash recession, but it was kind of created, right? They created that recession period. So while every inverted yield curve does not serve as a, it does kind of serve as a forecast, right? There is a term that was said that says every recession has had an inverted yield curve, but not every inverted yield curve has had a recession, right? So while the inverted yield curve is often an indicator that within 6 months to 2 years a recession will take place, an inverted yield curve does not always serve as a 100% factor. But I have seen a lot of people discussing the inverted yield curve just because of investors are looking at the economy. Stuff is still priced really high. Inflation is still 7%, 7.5% is 30-year rates on people that have 800 credit scores. So working at a financial institution, we're offering about 7.5% rates. That's crazy on mortgages, 30-year notes. So generally, the longer term loan that you take out, generally the risk is higher, and you get a little bit of a lower rate on that. But with the job reports are actually positive as well. I actually pulled up another article. So here's a little thing. Is there a recession every time the yield curve inverts? So a yield curve inversion, when rates for the 2-year treasury notes rise above those 10-year notes, has preceded every recession since the 1960s. The first clear inversion of the 15 years happened back in July 2022, although there were a brief and shallow inversion in August 2019-2022. All that's old news. Okay, so yeah, it basically showcases that yes, every recession has always had a yield curve inversion, but not every yield curve inversion leads to a recession. And here's another little article that I kind of pulled up here. And, again, it just kind of shows, it does not always serve to forecast a recession. There's other indicators to look at, such as the economy, job reports, inflation, wage growth. Wage growth is super low. Wage growth over the last year has been cut back really sharply. Job reports, jobs are still, it's so easy to get a job right now. Everyone's hiring. Wages, starting wages are pretty good, but wage growth, I feel like it's kind of stuttered. Inflation is still growing. I think the last was over 7%, and they thought they had it under control, but it's still moving. And then here is our yield curve little article right here. So back in 2020, we see that we did have a yield curve inversion, and that was I remember that being a big thing back in 2020. But you can see here we have actually broke quite a bit through that zero. I think we're inverted by about 0.86%, which is one of the highest points that we have had since the 1960s. So when we look at this and I use SPY and I look at the past recessions, I have this somewhere. Where am I doing this? Where is it? I know it's out here. It is. I know it's here. Recessions, right? So if we look at 2000 or late 2000 and we go back to this chart, here's 2000. Here's that, we had inversions here in the early 90s. We had inversion again in the mid 90s, but we had no recession tied to it. You see right through here, we didn't have any recessions through that inverted yield curve, but hey, here as that 2000 hit, we saw inverted yield dropped, not as sharp as we are now, but what took place then, we did have that crash. So boom, six months to 2 years later, we hit that recession period. And then here in 2008, if we look at the inversion, so here the curve, it inverted right here about 2008, and of course we saw there was a recession period here. And in 2020, we see that we did have, again, an inversion took place in 2020. And what happened? Again, we went through that flash crash, but quickly recovered out of there. And here we are once again in 2023, inverted higher than we had in the past. So this is just some articles, some news that I have seen around, like headlines, or people were putting out content on, inverted yield curve has historically led to standing recession warnings. This is like a tipping point, honestly, because in my last video, when I looked at the S&P 500 and I took a look at the 1 year, we can, even the 6 month year. No, we'll go back 3 years. I want to show you real quick. We had a death cross here with the short term 50-day blue line moved under that 200-day. So short term, we went negative, a lot of sentiment negative out there in the market, and the market went low. Let's go back 5 years. Let me show you here. So 50-day crossed under. So short term, we had some worries in our minds. So market took a dip. And then we had that golden cross, right? Blue line, which is the 50-day short term, cross over the long-term 200-day. That's a golden cross. And we gained there for a period. But this was something that nobody could have seen coming on like February 30th, or maybe it was like January 30th, February 30th. As soon as the market closed, there was like a huge drop where everybody's like, hey, it's a huge red day, negative 5%. I think tomorrow it'll recover. And then the next day, negative 5%. And then we're like, oh, maybe it'll recover now. Maybe we'll have a bounce. And no, just kept going down, down, down. But we see, that inversion there with the 50-day into the 200-day didn't happen until, we were already at the bottom. And then here on the recovery, that 50-day cross over the 200-day, so golden cross right here, we had a really nice, upwards motion here. Then we had that death cross again, moved down lower. We hit two double bottoms here with the lower front. We had two double bottoms here, kind of showing signs of support. This is a little bit weaker for support, right? And then if we look at here in the short term 6 months, we have had a golden cross. So this is what's kind of interesting. Fed saying that they have inflation under control. Jobs are still doing really well. Wage growth has kind of eased up. People, they're trying to really make people not go out there, spend a lot of money. I know in financial institutions, debit, no, ACH, deposits. Deposits are super low. That's the word. I know we were told this all the time here. Deposits are super low. People aren't coming in there and handing over their money. Times are tough right now. It's really hard to make their paycheck last month to month. So people are spending more. They're trying to, I think right now everyone's trying to have everybody prioritize needs over wants. Right now, everyone's in that want mentality. I want this, I want that, I want this to kind of make me happy in the short term. They need to get out of that mentality where, hey, maybe I can't buy that bag of chips, that extra soda drink, something that you don't need on a weekly, monthly basis to survive. So once the slowdown takes place, I think the market will have it'll be really choppy through here. This could go positive or it could go negative. So right now we're in that point where, what is it called? Not speculation, but there's uncertainty, right? It's uncertain. That's the thing with the market. There's a lot of uncertainty right now. Will we move higher? Will we move lower? There was a little article that I saw somewhere where the rug was basically pulled on short-term investors. Technical analysis show that, we could be in a bear trap. It's kind of an interesting little, so the S&P 500 reversed very sharply higher after Thursday's bear trap, right? Everybody thought, hey, this is it. The market's moving lower. It broke below. It actually broken below that short-term support, 397. It closed below and thought, a lot of bear investors like, hey, this is it. We broke. We closed below that 50-day. The market's going to downtrend from here. And then what happened? Huge recovery there on the following day. It went from 396 to 404. That's a pretty nice increase there on a 2-day period. So that definitely has people, again, on the fence. Are we going to move higher? Are we going to move lower? So these are all kind of, take it with a grain of salt. I don't know what a lot of investors are doing. I myself, again, I'm kind of sitting on the sidelines as far as equity investing. I have equity already invested in all my portfolios. Everything's so heavily invested with real estate, with stock market, stock market investing. But I haven't sold and removed equity out of my portfolios. So I'm still heavily invested. Majority of my investments are in the S&P 500. And then the tiny amount is with M1 Finance and stuff like that. I haven't updated my portfolio in a while, my overall portfolio, but that is basically it. So let me know down in the comment section below. Once again, the question of the video is, how much are you getting in dividends on a monthly basis or yearly basis? Are you brand new to dividend investing? And also, are you buying right now? Are you selling? Are you just kind of sitting tight with your hands under your lap? That's kind of what I'm doing, just kind of taking a look at the market, taking on the data in. I'm not negative, I'm not positive, I'm just kind of watching, because the market is going to trend like this. There's a lot of things that can be negative or positive. And I really haven't begun to move capital into the markets right now. I make a good portion with options, a couple $100 a month with options, and then just kind of take that equity and reinvest it on my other portfolios. So that's my current plan right now, just kind of using equity from options, reinvesting that, and then soon I will begin to probably max out my Roth IRA for this year. So that is going to be it for this video. Let me know down in the comment section the previous questions. I don't want to take up more of your time. And say hello in the comment section. Would really appreciate it. Okay, y'all. Have a good one. Bye-bye.